When is the time to sell your investment property? That is something that I get asked also on a daily or weekly basis. Is it time to sell? Should I keep holding? How long can this growth cycle keep going? If that's something you're interested in finding out, then you're going to want to stick around because we're going to unpack that. Guys, welcome back. My name's Julian. I'm the head of strategy here at Ripehouse. And if you're new to the channel, you've just tuned in, make sure you hit the like button and hit subscribe, because here we talk about property investing and all things finance related to property. And in today's video, we're going to unpack, I guess, maybe some key indicators that it could be time to exit a market, time to transition out. And I guess touching on that in the full disclaimer, I'm not somebody who's really pro always selling your property, trying to jump from market to market, because the reality is there's high selling costs and buying costs and capital gains tax, those things to consider. But if somebody was trying to decide, is the area looking to slow down, or is it potentially time to sell, what are some things we should start to look at? So I'm going to get into one of my favorite things here. One of the big ones is in terms of how long will the cycle last. So if you're looking for somebody who's pro into the 18.6 year property cycle, you've definitely stumbled across the wrong channel. I'm definitely not someone like that. And I guess there are absolutely mini cycles, and they float around from area to area. Not all cycles are equal. You can have certain cycles which might be really aggressive over a 2, 3, 5 year period. You might have cycles where that growth period could just be pretty consistent, could go for 7 to 12 years, something like that. So it's really hard to know precisely how long a cycle will last. But I think one thing is to take into consideration is a little bit of common sense in terms of what's unrealistic. If we were to use maybe the Perth market as an indicator right now, it's unrealistic to think that growth rates of 20, 25, 30% are going to continue to go for, say, 5 to 7 years. It's just something that won't happen. You'll then see Perth become the most expensive city in just a few short years. It's just something that's not really realistic. So there's going to be a slowdown before there's stagnation. So it's just understanding that not all cycles are going to be the same growth rates, and that means they won't be in the same length and tenure as well. So that's just something to take into consideration. But some of the key indicators, what are they? What are some things that we should be looking into? So I guess first one, a key sign is vacancy rates. So if you're in a market and you notice that vacancy rates are starting to creep up, that is normally an indicator of a couple things. You're going to start to see that there's potentially new supply coming through, which is causing the vacancy rates to decompress. And if vacancy rates are decompressing, then probably what's going to be happening is that's going to lead to stagnation in rental price movement, which, if there's stagnation in rental price movement, there's probably going to be less of a push through for investor cut through, which investors can make up to 30% in the market in terms of the buyers, right? So if you've got a reduction in your buyers, that's going to reduce your pool. So then there's less demand on the buying side, which means there could be a bit of a stagnation on property prices, or even a pullback. So number one is vacancy rates. The next one to take into consideration is days on market. So in another video, which we might have already gone through, but we talked about the Rockingham market, how days on market in that location is 9 days. So if it's taking 9 days and all of a sudden it blows out to, say, 20 or 30 days, well, that doesn't necessarily mean. I think it's probably understanding what is normal for the market, because 9 days is a hot market. Okay, that's going on the Wednesday or Thursday. It's being sold realistically over the weekend, but the agent flicks it through by the time the next week comes along. But if you're blowing out to, say, 20, 30, 40, 50 days, still within the normal range. When you're getting out to 60, 90, even more, obviously it'll be also dependent on where that property is located, because if we're in a metro urban area, we're going to see shorter days on market. Where if we're starting to get further out, you might get longer sales campaigns. But if that days on market continues to stretch out further and further, again, that's probably a sign of the market is starting to cool off a little bit as well. So next one is vendor discounting. So what that is, if we've got a property, say it's listed for 500,000, and there is a 5% vendor discounting on typical, on point of sale, it means that property is not getting its $500,000 listing price. It's going for 5% below that, so you're getting $475,000. If we are in a market where there is the reverse, where properties are getting listed for $500,000 and it's going for $525,000, that's an indicator of a hot market. Whereas if we're getting into a point where properties aren't meeting their listing price, that could be an indication of, vendor discounting is really rampant. Now, again, we want to have a look probably a bit more broader in terms of what are the agents' sales campaigns and technique, because just one or two listings not meeting their target, maybe the agents are getting greedy in a really hot market, as an example. But we want to just take into account, is there, are we not hitting our target? Are we just falling short, or is there significant discounting? If we're getting a combination of some of these other factors that we've mentioned before as well, these are all kind of key indicators that a market's either cooled down or continuing to cool down. And next one is affordability. So it's also understanding that affordability, in particularly in a higher interest rate environment, affordability is a key factor. So we've talked about this on the channel before, where we've seen places like Brisbane, like Perth, go through really, really big growth spikes, and that's off the back of really affordable markets to enter. $350,000, $450,000, $550,000, $550,000 price points to enter with really strong yields. All of a sudden, if your areas have started to become unaffordability, again, we mentioned earlier, you're starting to segment out investors. They may not have the serviceability to be able to purchase there. They might not be able to withstand the cash flow requirements to maintain that property, because potentially its yields come down. So affordability is a key one. If that area starts to lose affordability, not only potentially does it price out investors, it also might price out home buyers. They might no longer be able to afford to get that property from a first home buyer grant, from just a general servicing perspective as well. So it's not uncommon that you see really expensive properties. They can go through really volatile swings up or down because they are tied immensely to affordability and borrowing capacity. Whereas if you've got a $5 million property that's on the beach, how many people in that local area firstly can afford to buy that property, as opposed to a $500,000 property, right? So if you have 10 people that are interested in the $5 million property and their borrowing capacity comes down 20-30%, there might only be 4 or 5 left of them standing because of servicing, right? So it's understanding that affordability has a big part to play as well. Then there's also new supply risks. Understanding that has some new developed land just been purchased, developers are coming through. Now, not all supply risks are created equal, right? If you're living in an area where the median price is say $300,000, $400,000, $500,000, maybe even $600,000, and the new stock coming into the market is inferior in land size, but is costing $650,000, $750,000, $850,000 to purchase, then potentially that's not necessarily too much of a bad thing, assuming those vacancy rates also are still pretty tight. Now, if we've got supply risks, it's close to the current price points, and vacancy rates are starting to creep up. Again, some of these all tied together can be warning signs that market may start to pull back or stagnate. The next one is policy changes. So we can see, here or down on, we're not in Victoria today, but I am from Victoria, and we've seen that in the past where Queensland had that momentary lapse of common sense where it went to introduce a land tax, and we saw a flood of investors trying to pile out of Queensland, and interest in getting into Queensland cooled down for a very short window there while they were trying to get that one through. And in Victoria, it's no secret that over the last 12 to 24 months, particularly when the land tax was first announced, everybody was put off investing in Victoria. Now, common sense is starting to prevail when people have started to unpack the numbers around the land tax. It's not really too big of a deal in the Victorian stand front, but that can put off investors for a while. And if you've got basically no investors coming through for 12 to 24 months, that can affect your pricing as well. So that's a big one to consider as well. And then the next one is industry closure or slowdown, right? So if you're in an area which is really heavily reliant on certain industries. And some examples of this are, you could be in a mining town, you could be in a place that's really thriving off agriculture or thriving off tourism. If those industries go through big slowdowns or closures completely, you can see the value of those properties, collapse overnight. So it's a big reason why here at the business at Ripehouse, we have, we avoid areas that are just really relying on one or two industries. But if we want to see economic diversity, but if you're in an area which is really relying on those kind of sectors to a high degree, if you're getting early insight on that, government pullback, that can be something that can be quite devastating as well. So I guess in conclusion, unpacking and putting all that together, there's not really one key indicator that's going to tell you when is the appropriate time to sell. It's a bit like trying to catch falling knives at times. If we were to use stocks as a comparison, in general, your day traders trying to jump from market to market are normally the ones that go broke the quickest. And it can be a lot to be said about investors trying to jump from one market to the next market. You got to weigh up the costs in terms of, are those buying and selling and capital gains tax costs worth jumping from market to market? Potentially someone's watching this and going, well, it's not really about that. It's about me trying to mitigate my debt, or ease my cash flow burdens, or increase my borrowing capacity. But they are some key indicators. I guess if you have more questions on this, make sure you click the link in this video. Feel free to book into a call with myself or the team. More than happy to take your questions. But also make sure you leave a comment. Maybe you're one of those that just think you should never sell. Maybe you're somebody who's believing that you should be getting in and out of markets. What's your strategy? Would love to know. So thanks for watching for today. If you haven't already, make sure you're hitting like and subscribing, and we will catch you guys in the next one.